Welcome to Smart Wealth with Joshua.
Your daily stock analysis and catalyst talk. Today we're looking at Trump Media and Technology Group Corp.
If you find our talks useful, please consider subscribe, like, and comment underneath.
Yeah, and just real quick before we start, you can find the link to our StockOracle 14-day trial down in the description.
Right, which is an affiliate link, so that helps support this deep dive.
Definitely. And, always remember to verify any AI insights or value estimates yourself. They can be wrong, so do your own homework.
Exactly. We are all about long-term wealth building here, not short-term trading. We want to focus on protecting your capital.
Right.
So today, we are unpacking a really bizarre financial situation. And because this company, ticker DJT, is tied to a prominent political figure, we need to set a ground rule right away.
Yeah, a very important one.
We are leaving politics completely at the door, no right, no left. We are strictly looking at the math, the fundamentals, and the legal filings from late August 2026.
Absolutely, because honestly, from a pure business perspective, this is one of the most complex corporate structures on the market today.
It really is. I mean, it completely shatters traditional valuation models.
Oh, totally. Because it forces us to evaluate, well, non-traditional assets.
Right. So let's just get right into the Q2 2026 print. Because as someone who focuses on valuation and, protecting capital, the disconnect here is just staggering to me.
The numbers are wild.
Yeah. So on the surface, the company reported 89% year-over-year revenue growth, which sounds phenomenal.
For sure, if you just look at the percentage.
Exactly. But then you look at the absolute dollar amount.
Yeah.
That massive growth brought their total Q2 revenue for the existing engine to just $1.67 million.
Right. For the entire quarter.
For the whole quarter. I mean, there are individual, local fast food franchises that do more volume than that.
Oh, without a doubt.
And to make it worse, the net loss for that exact same quarter was $238 million.
Yeah, that is a steep drop.
So, okay, let's unpack this. They bring in $1.5 million bucks, but lose over $200 million. Yet, even with the stock down roughly 47% over the past year, trading around $9.10 right now, the market is valuing this company at 618 times its trailing sales.
Which is astronomical.
It's absurd. Even hyper-growth tech monopolies rarely breach, like 30 or 40 times sales. How are institutional investors justifying a multi-billion-dollar market cap for a company with restaurant-level revenue? Where is the durable growth?
Well, if we connect this to the bigger picture, the reality is that the market isn't valuing the existing advertising business at all.
Really?
Yeah, I mean, the traditional ad-based social media model is effectively a rounding error here.
Yeah.
What the market is actually pricing in is sentiment and what analysts call transformational optionality.
Okay, optionality.
Right. The research highlights that DJT is operating as an event-driven stock. It has a massive beta of 4.16.
Wait, hold on. A beta of 4.16.
Yeah.
That means it's completely detached from macroeconomic reality.
Sorry.
If the broader market drops 1%, this thing theoretically violently swings over 4%. How do you even model risk for something like that? It's not safe capital allocation.
Well, they don't model it for long-term stability, that's for sure. They model it for momentum.
Yeah.
And mimetic arbitrage.
Mimetic arbitrage, wow.
Yeah. High-frequency trading firms love a beta that high. They aren't paying for the ad revenue. They are exploiting the sheer velocity of the price action. Every time there's a news event surrounding the founder, retail volume spikes, and the algorithms just front-run that volatility.
Okay, but relying on algorithmic trading volume doesn't pay your operating expenses.
Right.
It doesn't build long-term wealth.
Yeah.
At some point, you actually have to monetize that attention into real durable cash flow, right?
Exactly. Which is why the company is aggressively trying to pivot. They know that competing for ad dollars against established tech giants is just a losing battle with their current user base.
Right.
So they need a completely different emerging growth engine.
And here is where it gets really interesting for the thesis. On August 1st, 2026, they launched this new product called the Truth API.
Yes.
And this isn't a consumer product, right?
Yeah.
This is a pure B2B play targeting institutional finance.
It is a brilliant pivot, mechanically speaking.
Yeah.
Oh, absolutely. They are bypassing the advertising market entirely and going straight to Wall Street.
So for you listening, what the Truth API does is it gives hedge funds and quantitative analysts instantaneous access to the founder's market-moving posts.
Right. It's essentially a financial fast lane.
Yeah, like an HOV lane.
Yeah.
These funds aren't paying to read the content for fun. They are paying for the millisecond head start to feed that text into their natural language processing algorithms.
Exactly. To execute trades before the retail traffic jams up the market. In institutional finance, latency is everything.
Right. Every microsecond counts.
If a single post mentions a specific tariff or a particular publicly traded company, the algorithms can parse that sentiment instantly. If you are relying on scraping a public web page, you are already too late.
You're just liquidity at that point.
Exactly. You are the liquidity for the funds that have direct API access.
So they are monetizing a scarcity mode. There is only one source for this specific stream of data. It's totally unreplicable. And according to the research, the market is willing to pay an unbelievable premium for it.
Oh, yeah. The numbers are staggering.
Within 10 days of launch, they had over 10 paying customers, with media reports citing unconfirmed deals of up to $100,000 a month per institution.
Which is huge. I mean, think about the margin profile on that.
Right.
They are taking data that already exists on their servers and just routing it through a dedicated pipe. The gross margins on an enterprise API feed are functionally near 100%.
Pure profit, basically.
Pretty much. If those $100,000 a month figures are accurate, signing up just 50 institutional clients generates $60 million a year in recurring contracted revenue.
Wow.
It completely rewrites that dismal $1.6 million quarterly print we talked about.
It really does. It transforms them into a highly lucrative financial data vendor.
Right.
But from a risk management perspective, this is a massive, but the research identifies a critical near-term threat to this catalyst.
The lawsuits.
The lawsuits. The API is currently under severe legal threat. Media groups are actively suing to shut it down on First Amendment grounds.
And this raises such an important question about, well, the legal definition of political speech in the digital age.
Right.
The plaintiffs are arguing that putting a high-speed institutional paywall in front of a political figure's direct communications creates a two-tiered system.
Like it violates public forum doctrine.
Exactly.
So the argument is that Wall Street can't buy a head start on political speech while the general public has to wait for a page to load. That creates unprecedented regulatory friction.
It really does.
And on top of that, the research notes a senator has publicly alleged corruption regarding this exact setup. If a federal judge decides to slap an injunction on this API while the court sort it out,
then the emerging growth engine stalls out overnight.
just dead in the water.
Right. An injunction means they have to turn off the API feed until the litigation is resolved, which, could take years.
Years of legal fees.
Yeah. And financially speaking, if they lose this recurring revenue stream, they are trapped. The core advertising business is negligible, and they are left holding expensive infrastructure without a clear way to monetize it.
So if your primary path to sustainable wealth creation is trapped in a courtroom, what do? You have to change the narrative.
You have to buy a massive pivot.
Right. Which brings us to the absolute wild card of this research packet, the optionality play. The proposed Q4 2026 merger with TAE Technologies.
It is definitely the most jarring data point in the entire report.
I mean, I am genuinely struggling to wrap my head around the financial logic here. I'm looking at a social media company operating in the political attention economy, suddenly attempting to merge with a nuclear fusion startup.
I know, it sounds crazy.
Please make this make sense. How do these two completely unrelated sectors fit together under one ticker?
Well, what's fascinating here is that you have to stop looking at DJT as an operating company.
Okay.
And start looking at it as a holding company. Think of it like a highly volatile, sentiment-driven SPAC.
A special purpose acquisition company.
Exactly. The management team knows the core social media business is struggling to scale. But what they do have is a publicly traded vehicle with a multi-billion-dollar market cap and immense retail liquidity.
So they're using the equity as currency.
Right. They are using that stock to buy transformational optionality.
So it's essentially buying a lottery ticket in a completely different, potentially world-changing industry. They aren't trying to find synergies between social media and plasma physics.
No, not at all.
They are just trying to bolt a high-upside energy play onto their ticker.
Precisely. TAE Technologies is one of the more prominent private companies working on commercializing nuclear fusion. If this medium-term catalyst closes, DJT instantly morphs from a micro-revenue social network into a diversified holding company with exposure to the future of global energy.
It definitely changes the conversation.
It completely changes how Wall Street looks at them.
But look, buying an energy company isn't cheap. especially one working on something as capital-intensive as nuclear fusion. And as someone focused on protecting shareholder value, the research flags a massive risk here: dilution.
And that is the inescapable reality of these types of acquisitions. To buy a company the size of T-Gate Technologies, DJT cannot just write a cash check.
Right, they don't have the cash.
Exactly. They have to issue a massive amount of new stock.
Which expands the float. If you hold a share today, your slice of the pie gets mathematically sliced much thinner when millions of new shares flood the market to pay for this merger.
Yes.
You get a piece of a fusion company, sure, but your ownership percentage of the total enterprise collapses. That destroys long-term compounding value if not managed perfectly.
It's the ultimate trade-off for current shareholders. You are trading away your equity concentration today for a chance at a completely different, massive revenue stream decades from now.
Decades.
Right, because getting from here to the commercialization of fusion energy requires billions in capital.
And that brings us to the actual treasury. Because buying a fusion company, fighting First Amendment lawsuits, running servers, it all takes immense capital.
It really does.
To understand if DJT can even survive long enough to see these plans through, we had to tear open their highly unusual balance sheet.
It is a balance sheet full of contradictions, and it features one massive ticking clock.
Let's start with the top-line numbers. The company boasts a little over $2 billion in total assets, and they have a cash cushion of about $215.4 million in unrestricted cash.
That $215 million is their runway. It buys them time to execute the API or close the merger.
But then you look at the liability side of the ledger. They are carrying roughly $970 million in long-term debt. And here's the truly terrifying part for any investor. Almost all of it is classified as current.
Meaning it matures or becomes fully due within the next 12 months.
Right. And basic math tells us that $215 million in cash cannot cover a $970 million debt maturity.
No, it cannot.
That is a near-term catalyst in the worst way. A ticking clock. They either have to refinance that debt in an unforgiving interest rate environment, I mean, for a company with $1.6 million in quarterly revenue, or they have to issue more stock to raise the cash, triggering even more dilution.
The debt wall is the single most pressing existential threat to the company. If they can't refinance or raise the capital, the entire holding company structure begins to unravel.
Okay, but this is where I need to stop you. Because there is a glaring math discrepancy in the cash flow statements in this research.
Oh, right.
We established earlier that the Q2 net loss was $238 million. Yet if you look at the actual cash flow statement, the operating cash outflow for the entire first half of the year was only $13.7 million.
Yeah, it looks bizarre at first glance.
How is that functionally possible? How do you report losing hundreds of millions on the income statement, but only actually burn $13 million in operating cash? Where is the phantom money going?
This is where we have to dive into the nuances of GAAP accounting rules, specifically regarding digital assets. That massive gap between the reported net loss and the actual operating cash burn is driven almost entirely by non-cash factors on the balance sheet.
Like what?
Well, the research confirms that DJT holds a massive treasury of cryptocurrency, specifically substantial holdings in Bitcoin and Kronos.
Wait. So on top of the social media platform and the pending nuclear fusion merger, they are also operating as a corporate crypto whale.
Precisely. And under current accounting standards, corporate entities that hold digital assets have to mark those assets to market.
Oh, I see.
Because cryptocurrency is notoriously volatile, the value of that treasury swings wildly from quarter to quarter.
So it's a paper loss. If the broader crypto market takes a steep dive over the quarter, DJT has to record a massive impairment loss on their income statement, even though they didn't actually spend a single physical dollar operating the business.
Exactly. In fact, the research notes that the total asset base dropped by about $611 million over the half year. The core business didn't burn $611 million. The value of their digital treasury simply contracted. By holding Bitcoin on the balance sheet, DJT has functionally turned itself into an unregulated crypto proxy stock for retail investors.
It adds an incredible layer of chaos to the valuation. The nine-figure GAAP losses we see making headlines are heavily skewed by Bitcoin and Kronos just swinging around. It's not the underlying business burning hundreds of millions in cash.
Right. It's their digital gold bars changing in value every single day.
Unbelievable.
It creates balance sheet optionality, though. If crypto enters a massive bull run, their asset base looks incredible, and it might give them the leverage they need to refinance that $970 million debt.
But it imports a tremendous amount of systemic volatility that has absolutely nothing to do with their core competency.
True.
So what does this all mean for wealth building? When you take the First Amendment lawsuits threatening the Truth API, the nuclear fusion merger, the massive crypto treasury, and that looming billion-dollar debt maturity, how are analysts actually grading this thing?
Unsurprisingly, the research report's overall rating gives it a 3 out of 5, which in their methodology leans heavily bearish.
And internal management seems to agree, right? The insider sentiment score is a -100, which is mathematically as low as the scale goes.
Yeah, that means there have been 0 open market purchases by company insiders. The executives are not buying their own stock.
When insiders refuse to buy at a 47% discount from the yearly high, that is a glaring signal to the broader market. So let's lay out the 12-month base case the analysts have constructed.
Okay, in this base case, DJT remains essentially paralyzed. It continues as a minimal revenue, large paper loss company. The stock continues to trade purely on mimetic news events and algorithmic volatility.
Meanwhile, they're bleeding legal fees, fighting the media groups in court over the API, all while that $970 million debt clock ticks closer to zero.
Right. The base case is a brutal struggle for fundamental survival, masked by an astronomical valuation multiple that makes 0 structural sense.
But to be fair to the scope of the research, we have to look at the absolute inverse. The analysts also map out a 3 to 5 year blue sky scenario.
Yes.
And we must emphasize to everyone listening, this is strictly an optimistic hypothetical to model upside. It is not a prediction of what will happen.
Right. A blue sky scenario requires a highly improbable chain of independent events to all execute flawlessly. If even one link breaks, the entire thesis collapses.
Okay, let's play the hypothetical out. Step 1. DJT wins a massive victory in federal court. The First Amendment lawsuits are dismissed, and the Truth API is deemed perfectly legal.
Step 2. With legal clarity secured, the institutional sales team goes into overdrive. They scale the Truth API rapidly, signing up hundreds of hedge funds at $100,000 a month, instantly generating a durable, high-margin revenue engine.
Step 3. The TAE Technologies nuclear fusion merger successfully closes in Q4. And through financial engineering, management structures the deal so that shareholder dilution is kept to an absolute minimum. DJT now owns a viable stake in the commercialization of next-generation energy.
And step 4. The cryptocurrency markets enter a sustained bull run. The value of their Bitcoin and Kronos treasury skyrockets, providing a fortified balance sheet that allows them to easily refinance or entirely pay down that $970 million debt.
If that exact sequence of miracles happens, that absurd 618 times sales valuation actually starts to make logical sense.
Yeah.
Not because the stock price crashes to meet the low revenue, but because the revenue denominator grows so massively that the company actually grows into its valuation.
It is the ultimate grow into your multiple scenario. It transforms them from a sentiment-traded micro-revenue stock into a diversified cash-flowing media plus energy holding company. But again, every single one of those catalysts is entirely unproven today.
We've covered a staggering amount of ground today. To synthesize all of this into a wealth-building verdict, DJT is sitting at a high-stakes existential inflection point. Its strongest long-term driver is the successful pivot into B2B data and fusion optionality.
Right. It has to prove it can take the raw, undeniable attention its founder commands and convert it into legally defensible, recurring revenue.
Exactly. But the biggest threat is that it has to execute that pivot while simultaneously juggling a billion-dollar debt maturity, absorbing the violent swings of a crypto treasury, and surviving those First Amendment lawsuits.
It is a corporate balancing act with 0 margin for error.
Which brings us to the final provocative thought we want to leave you with today. When we look at all these wildly disparate elements, the beta of 4.16, the multiple of 618, the crypto, the API, it points to a structural shift in how markets operate.
We have clearly entered an era where a company's fundamental financial health can be completely detached from its equity value in public markets.
It really makes you wonder, if human attention is officially replacing traditional cash flow as the ultimate corporate asset, are we heading toward a future where index funds are forced to track social media engagement and mimetic velocity instead of quarterly earnings?
It's wild to think about.
If influence is the new capital, and trading desks are willing to prop up a multi-billion-dollar valuation just to trade the volatility of a single person's posts, then traditional accounting metrics might already be functionally obsolete.
It fundamentally changes the definition of what a valuable company actually is.
It's something to deeply consider the next time you look at a stock chart that just doesn't seem to make mathematical sense. Thank you for joining us on this deep dive. Don't forget to check out the Stock Oracle link in the description. Keep questioning the numbers behind the headlines, and we'll catch you next time.